The markets remain in a bit of a risk-off trade heading into the final hours of Friday's session. Hello traders, this is Fawad Razak, market analyst for City Index. Let's get into it. If you're wondering why the equity markets in the US are down so sharply this week, well, look no further than the Nvidia stock, which is down over 10% at the time of recording, creating a bearish engulfing light candle on its weekly chart. If it closes this way, it would point to further weakness in the week ahead. Now, the AI euphoria has eased a little bit, as you can see, and that has put a lot of pressure on the semiconductor and information and technology sectors, which is why the Nasdaq is underperforming all of a sudden. Now, the sell-off in Nvidia and other semiconductors have created a bit of a correction in the Nasdaq chart, as you can see here. It has broken below this key area of support between 25,000 to 25,200, the shaded gray area, which is now a bearish development if it can close the session this way. Unless it rallies from the lows and climbs back above this level on a closing basis today, which appears unlikely at the moment, then we could potentially see further weakness in the days ahead, with the next downside target being this low here at around 23,980. Below that, we don't have any obvious targets, so we could possibly see the index come all the way back down to this long-term area of support. I've shaded in green on the chart, which was the previous resistance and all-time highs before we broke out of it in June and never retested it from above. We have the 200-day moving average also converging there. So that's a massive area of support. And can the index pull back all the way to that area remains to be seen. But if it does, this is where I would expect the index to potentially stage the next leg of the rally. But we'll cross that bridge if and when we get there. For the time being, let's see where the index closes today's session. Concerns about the US labor market have come back to the forefront, and this has caused the US dollar to weaken once again after it staged a recovery last week. Remember when the Fed chair was quite hawkish at the ECB press conference. But economic data from the private sector hasn't been great, as we found out this week, and that has caused renewed weakness in the US dollar. And among the currency pairs to watch now is the dollar yen, because it has found additional resistance from the ongoing risk-off trade, with the currency pair also finding resistance from technical point of view from this bearish trend line that has been in place since July of 2024. This trend line comes in at around 154, and we've tested this level on a number of occasions this weekend. So far it has held. Right now, at the time of this recording, the dollar yen was testing support at 153, this level being the base of the breakout when the Fed chair spoke last week. So we've given back all of those gains. But if we now go below this area, then that could potentially trigger some stops and lead to a possible drop towards 152. Initially, possibly below that to 151 thereafter. And then 150 is the key level next. Will we get there next week? Well, a lot will now depend on the direction of the risk assets, and in particular the Nasdaq and Nvidia stock. And if sentiment remains bearish next week, we could well see some further strength for the Japanese yen, which is deemed to be a haven currency at times like now. So we could possibly see some further weakness in the dollar yen heading into next week. In terms of resistance, well, I mentioned 154 being the key level to watch on the upside. Should we break above that, then 155 could be the next upside target. But to get there, either risk appetite needs to improve markedly, or we'll need to see a strong recovery in US dollar across the board. Don't forget to like and subscribe, and for more market updates, head over to cityindex.com. See you in the next video. Take care.